Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra and with me is my colleague Ekta Batra. Ekta, good afternoon. Well, after yesterday's flattish moves, we did see a big fall in markets today, led by, of course, the IT space. That index was down 5%. Mid-caps didn't do so well, but banks absolutely flat.
Well, yes, it was definitely a down day for the markets today. The Nifty just about tried to fight to hold on to that 25,800 mark in today's trading session. But we did have the Nifty IT index, which was one of the key reasons to blame for that. So ending at around 5.5% cut in terms of the Nifty IT index. What stood out was the resilience definitely for the financial space. So we had the Bank Nifty, which ended absolutely flat as compared to the Nifty, which was down 0.5%, and the mid-cap index, which was down around 0.5% as well. But let's tell you what we have lined up for you in store in the next 30 odd minutes. We have the top movers and shakers of the day with Sudarshan Kumar. We'll also put the spotlight on the big IT sell-off, which was the biggest talking point today, decode HUL's Q3 numbers and tell you why Lenskart witnessed a big rally. But last but not least, we'll delve into the key market events to watch out for in tomorrow's trading session. But let's get to our first segment of the day. This evening, we have Sudarshan joining in from the wall to tell us about all of the big stocks in focus today. Sudarshan, over to you.
One sector that has dragged the market most is the IT, and that's because the AI-related concerns are back in the limelight. You can talk about all the top Nifty gainers, TCS, Wipro, Tech Mahindra, HUL Tech, Infosys. All these stocks have seen a sharp fall down somewhere in the range of 5 to 6%, and at the end, Nifty IT has erased market cap of more than rupees 1.5 lakh crore today, and that index also has closed with a cut of more than 5%. What has supported the market was the financial pack. Bajaj Finance, Shriram Finance, ICICI Bank and SBI continues to see an up move, and today all these stocks you can see somewhere up in the range of 1 to 3%, and Shriram Finance has been moving higher continuously, even same with SBI and Bajaj Finance. Some of the stocks have reacted to earnings. On top of the list is Max Finance. It was a beat in Q3. After that, there was a positive comment in the con call, and that's the reason there was a sharp move in the stock, closed with a gain of 5%. Lenskart, it was an all-round beat in Q3. That's the reason, sharp up move, 14% higher. Bharat Forge earnings were steady, but what led the stock to move higher was the commentary that company has given that worst is behind, and they are expecting more than 25% growth in FY27. That's the reason the stock was 3% higher. Also, Lincoln Pharma has provided with a very good set of earnings for Q3 FY26, and that stock also closed higher. And lastly, some of the stocks have reacted to the commentary coming in from Trade Minister Piyush Goyal. He has said that the benefits that Bangladesh will receive from the trade deal with US, same benefits will come to India also, and because of that, Apex Frozen, Avanti Feeds, Gokaldas Exports has seen a sharp up move from day's low and closed with a gain of Avanti Feeds up 20%, Apex Frozen 19%, and Gokaldas too has moved 4% higher.
Okay, interesting names there. Thank you so much for joining us with all those details, Sudarshan. To the big sector of the day, Indian IT stocks feel the heat due to a sell-off in global tech stocks and AI disruption fears. The index tanked 5% with heavyweights like Infosys and TCS seeing a 5% fall. Reema Tendulkar is here with all the details. Reema, what's hurting these IT stocks?
Well, the pain in the tech sector that you're seeing today is not an India story. It's a global problem. The Nifty IT index is down 10% year to date. Heavyweights like TCS, Wipro have hit fresh 52-week lows, and now a company like TCS is down more than 10% in the last 5 years, negative 5-year returns. Global software names have cracked very sharply. You're seeing steep cuts of about 30% across some of these enterprise tech names like ServiceNow, Salesforce. Now, the Indian IT sector and the technology majors have disrupted many cycles before, whether it's Y2K to cloud. But the question this time is that whether what we're seeing in AI, and more importantly, the pace of innovation, represents just another transition, or is it a fundamentally different risk, a structural headwind? Let's get the experts in. Now, Citi says this AI shift has unique challenges, and they give you 3 reasons for that. Unlike the cloud cycle, where the Indian IT sector was the challenger, gaining share, this time it's entering in as the incumbent. The sector has doubled in size since the last major tech shift, making it more exposed to disruption rather than being the disruptor. 2, the AI's impact is far more pervasive this time. When cloud took place, it primarily reshaped infrastructure where data was being saved. But generative AI is touching coding, consulting, workflows, decision-making, and even labor pools. And finally, Citi makes the argument that the new AI revenue pools coming in from AI are still very small, still exploratory, so not enough to offset the pressure seen on legacy services. But unlike in the case of cloud, when new work came in, there were large deals. But brokerage views are still a divided house. Now, HSBC offers a counterpart. They think that LLM-driven products will not materially displace SaaS, pointing out that there are virtually no documented instances of a Fortune 500 company replacing a core SAP or a CRM platform with a standalone AI model. Two, they're saying that, there are decades of business contextual knowledge embedded in these platforms like SAP and Salesforce, and that remains a strong moat, so it's not that easy to simply replace it. What HSBC says for the Indian IT services company, the major problem is the sharp increase that we're seeing in coding productivity. Now, as of now, according to the industry estimates, productivity gains are about 8 to 10%. But the recent launch of Claude Opus 4.6 is estimated to add another 500 basis points of improvement in productivity. Now, this incremental productivity or efficiency could increase the revenue deflation, pricing pressure. But HSBC still believes the impact is not going to be very materially significant at this stage. To sum it up, HSBC says that we acknowledge this time the risks are more credible than the past cycles, but they still expect a low teens return from IT in 2026. So what is your view? Is AI an existential threat to IT services, or simply the next evolution that reshapes growth rather than ending it?
Okay, all right, Reema, thanks very much for that. So as of now, however, the IT stocks are completely spooked. However, industry has played down these fears. Both M&M and LTI Mindtree say that the current market reaction is overblown. Listen in.
So this is, first, it's way overblown. And the death of the pyramid has been forecast multiple times over the last 30 years at every inflection point where technologies come in, starting from Y2K. And then call centers, and then we had blockchain coming in. There are various different technologies that have come in that have disrupted this industry, and the industry always has evolved. Because if you look at what it is today versus even 5 years ago or 10 years ago, it's a very different industry. AI brings up a number of opportunities, and even over the last few years, companies have stopped talking as much about help us with productivity and lower costs, and are talking more about help us win in the marketplace, and that creates a completely different set of opportunities. So how we go to market is very different. The AI disruption also has been known for the last couple of years.
The risks are overblown or exaggerated, right? Is there an impact of AI on certain tasks and certain services that we have today? Yes, it has, right? But at the same breath, are there greater opportunities on how we can use AI technologies, tools, and platforms and the models, to create new offerings, new capabilities, and new services to address our client needs? The answer is big yes. And at every technology change, we have gone through some structural alignment, as an industry and as a company. So this is no different. Yes, the only difference in this case is the innovation is happening within the short cycle than what we were used to 5 years or 10 years back.
Okay, all right. That's the opinions coming in from IT companies. To take this discussion forward, we are now joined by Sudeep Bandopadhyay from IndiTrade Capital Limited and Richard Jain from Motilal Oswal Financial Services. Gentlemen, good afternoon. Thank you so much for joining in. Well, before talking the fundamentals, Richard, I wanted to understand from you on the Nifty IT index. It's 20% off from its 52-week level highs, and a lot of these stocks are at 52-week lows as well. Do you think these are important support levels, or we could see further downside?
I think the initial support was already broken on 3rd of Feb when we witnessed that huge gap down opening. The Nifty IT index breached its 200 DMA after a long consolidation phase, and post then what we are witnessing right now since last couple of sessions is just a follow-up move which we generally see in a downtrend. Now, not only on the daily charts but also the 200 weekly EMA has been breached this week. So definitely these are not good signs for the medium term as well. So I think in the coming days we are likely to witness a continuation of the down move, and probably the previous swing lows which were around 32,000 could be there on the Nifty IT index. So better not to do any kind of bottom fishing here. And as we say, in technical parlance, that not to catch a falling knife. So it is just like a falling knife which one should avoid any kind of bottom fishing here.
Okay, all right. Well, Sudeep, what is your view in terms of a couple of these IT stocks? Would you now be a buyer at these levels?
No, definitely not. I think you just mentioned there is no point trying to catch a falling knife, whether it's technical or fundamental, no point catching. So look, the AI-related disruption is real, and I think we are just at the beginning of this disruption. There is a long way to go before we can conclusively say which part of this disruption is real, which is not real, who benefits and who loses out. I think we are just at the beginning. But the reality is our IT companies, particularly the large ones, will definitely have pressure on revenue, margins, and profit. Under the circumstances, I think the valuations will be under pressure. There is absolutely no point trying to buy these stocks now. Let's wait and watch. They are good companies. I'm sure they will navigate this challenge effectively. They will evolve and they will figure out ways of handling it. But it will take time, and I think we should wait and watch instead of just rushing into it at this stage.
Take that point, Sudeep. Thank you for your thoughts on that. Let's go to the next big sector. HUL fell 2% after it came out with an inline set of numbers in third quarter, but volumes beat estimates. Mangalam Malu is here with the details. Mangalam, take us through the earnings fine print.
Well, these numbers are largely in line for HUL. Soft expectations largely because of the disruption in October, even though the company said that things have improved and normalized in the month of December. So let's look at numbers in two particular ways. One, they've reported this number X their ice cream business, and the analysts, they make their estimates based on the standalone numbers. So as compared to our poll, which is on the standalone basis, the revenue at 15,805 crores, slightly shy of 16,000 crores that the analysts were expecting. EBITDA at 3640 crores as well, as compared to analyst expectations of 3725 crores. Margins at 23%, largely in line, and the net profit also largely in line. What's good, however, is that the underlying volume growth has come in at 4%. The street was expecting a number anywhere between 2 to 3%. Management commentary, they're saying that there is conducive backdrop for consumption pickup. In fact, they expect FY27 to be better than FY26, and they've maintained their margin band at around 22 to 23%. Now, the consolidated business, where the company actually takes into account the acquisitions that they made as well, the likes of Oziva, etc., and also that of Minimalist, the reported revenue growth has been 5.7%. Here, the reported EBITDA growth has been nearly 3%. The net profit has been impacted by exceptionals. Remember, this time around there was an exceptional loss of 576 crores. At the same time last year, they had an exceptional gain of 538 crores. Home care business grew 2.5%. Beauty and well-being grew about 10.5%, and personal care as well as foods grew anywhere between 5.5% to 6%. So largely in line with soft expectations. The stock, which at one point was lower, saw recovery.
Revenue has actually grown by 6%. Yeah. On the profit part of it, I think you should look at three levels of that. Yeah. From the discontinued operations. Number one is your EBITDA growth. Our EBITDA growth is 3%. Our margin is 23.3%. The EBITDA margins include a one-time charge which you have taken on account of the gratuity impact of the labor code, and that is around 110 crores. So obviously adjusted for that, if you look at it, an EBITDA margin would have been also close to around 5% growth, yeah, at around 24%. Of course, in the quarter, the A&P has been a little lower in terms of percentage to the revenue, which will get stepped up moving forward. So the quality of the growth has been very good in terms of our EBITDA growth, absolute, that you talk about.
We are seeing an improvement in consumer sentiment and demand. This is especially led out of rural, but overall across urban and rural, demand and sentiment is improving. I think both the macro factors contributing, whether it is the low inflation, the all the reforms that the government has done, is leading to an overall improvement in sentiment. It is also combined with the measures that we have taken, whether it's in terms of our portfolio transformation, the channel double down that we are doing across, the modernizing of our brands, and going behind market development as the market leaders in the country. This is really starting to pay the dividends. So we don't give guidance of specific numbers, but what we are saying is that second half 26 will be better than first half 26, and 27 will be better than 26.
Okay, all right. So that's the management of HUL. Sudeep, would you be a buyer based on that guidance that FY27 is possibly going to be better than FY26?
Well, I think the management body language was very, very confident, and that gives some room for us to go and buy. from a long-term perspective. The other comment which the new MD also made is that rural demand has really come back. That's again very positive for the entire FMCG industry, and HUL, Dabur, and the others who have significant rural business in particular. So I think I'm comfortable buying HUL at current levels. I think it has been languishing for a very long period, and probably it's the right time to get into HUL and some of the FMCG names. Look, we don't expect scorching growth or overnight doubling, things like that, which happens in a lot of new age companies and other businesses. But if you are looking for steady, stable returns, I think it is probably a place to look at in the current fiscal as well as the next fiscal.
Take that point, Sudeep. Richard, we'll come to you in just a bit, but before that, let's talk about Lenskart. The stock rallied 13% after it showed a sharp improvement in profits as operating leverage kicked in. Sales also saw strong growth both in India and overseas. Mangalam is back with us to take us through the company's Q3 performance. Mangalam.
Well, Lenskart was a solid set. The operating leverage, the benefits of that are beginning to play out right now. Year on year, the company reported a revenue growth of 38%, and the EBITDA actually expanded by over 100%, 118%. In fact, margins came in from 12.5% all the way up to 20%, and that reflected in a net profit of around 130 crores. There was growth on both domestic as well as the international business front, and in domestic in particular, there was over 35% same PIN code growth, which told you that the total addressable market was expanding, and add to that, the company saw 30% volume growth, and 7% of the growth was led by premiumization because average sales price increased without the company taking some price hikes. So all these factors led to brokerages upping their estimates. Jefferies, in fact, has upped their EBITDA estimates by about 6 to 9% and upped their target price on the stock as well. The stock did well today.
Okay, all right, Mangalam, thanks very much for that. So that's on Lenskart. Richard, any view on this entire set of stocks, the newer listings? I know not much data technically, but in any case, what would your view be?
I think yes, one good thing is that the volumes have started picking up in some of these names, especially Lenskart, what we witnessed today post that gap up opening, also good volumes were there. So although I don't have much data to analyze, but if the price increase is supported by good volume, that then clearly indicates a buying interest, and that's what we have seen in Lenskart after this consolidation post listing. I mean, as far as the stock trades above that 460, 470 mark, which is the short term support, the overall momentum could continue to stay on the positive side.
All right, Sudeep, quick word on this.
I think I do like Lenskart, not from a buying point of view, but the way they're building the business. I think the international expansion has been very timely. They talk about tech business and things like that. I don't give them a tech valuation. I don't want to give them. They command a valuation multiple of close to 180 at this stage, which is absolutely unrealistic. So I don't recommend a buy, but it's worth the space to watch. And international expansion should do them very good going forward. I think the entire numbers business depends on how quickly they can expand and how continuously they can expand. Because if the growth numbers starts faltering, then the valuation multiple will crash. So you have to be very careful if you're an investor in Lenskart and keep watching the space and their growth numbers very carefully.
Okay, all right, Sudeep as well as Richard, thanks very much for joining in and taking us through all of those views this afternoon. We're going to take a short break, but we'll get you all of the top corporate voices along with the key market events to watch out for on the other side. Stay tuned. Welcome back. You're still tuned into Markets Forward. Time to take stock of all of the big corporate voices of the day. Baba Kalyani, Managing Director of Bharat Forge, said that the company expects growth of over 25% in FY27, with a recovery already visible in the North American business. Speaking about the advanced towed artillery gun system orders, he noted that the process was nearing completion, with production clearance expected by March. The review of the European business is also set to conclude by the end of this fiscal year. He added that the defense segment could see a growth of over 50% next year.
The management of LG Electronics told CNBC-TV18 that the company's margin pressures were temporary. This was driven by foreign exchange fluctuations, higher input costs and operational deleveraging. The management added that the fourth quarter was showing strong demand signals backed by a robust summer season, accounting for 28% of the company's business. LG Electronics is targeting a revenue growth of 10% in quarter 4 with an EBITDA margin of 10 to 13%.
And days after reporting a weak Q3 with a sharp fall in profitability, BEML's CMD Shantanu Roy said that the company was targeting an EBITDA margin of 13 to 14% in FY26. Speaking to CNBC-TV18, he added that it was guiding for a 20% year-on-year revenue growth. Roy also said that they were looking to expand its rail manufacturing capacity by 300 coaches per year after phase 1 of its 1,500 crore capital expenditure plan. He also said that defense margins were stronger than its core business.
After delivering a strong third quarter, Ashok Leyland's MD and CEO Shenu Agrawal said that the last 3 months were very strong for CV sales and they expect the momentum to continue in February. He added that demand was robust across all segments and also pointed out the export volumes grew 20% in quarter 3 and the company is now looking to expand the business with an aggressive push in ASEAN countries.
Alright, and before we wrap, let's bring you some of the key events to watch out for. Sudarshan is standing by to tell us more. Sudarshan.
So some of the global data we're expecting today evening is the first US jobless claims. UK will be coming out with the manufacturing production, and also IEA will be releasing the monthly report related to the oil. Marico will be in focus tomorrow because it's holding the investor day and it's the last day of the Q3 FY26 earnings. Two major stocks or two major companies that will be reporting earnings, and those are NBCC and Torrent Pharma.
Is amazing news. Thank you so much, Sudarshan. So we are towards the fag end of the earnings season and some of the events we'll be watching out for tomorrow. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.